One of the most important things to understand when it comes to estate planning is calculating the true cost of liquidity. In other words, does it make more sense for the client to leave their investments inside their taxable estate, which are going to be subject to 40% in estate taxes at end of life, or does it make more sense to reposition some of those funds outside the taxable estate in an irrevocable life insurance trust, and then use those funds to purchase a life insurance policy? So we've built a model that will calculate the true cost of liquidity. In other words, we calculate the outcome of those investment funds if the client leaves them inside their taxable estate versus the projected outcome if they reposition those funds inside a life insurance policy. We take a look at obviously the early years, but more importantly, we take a look at the projected outcomes right around life expectancy. In this webinar, I'm going to model several different asset classes and show the projected outcomes at life expectancy so you can see which one mathematically makes more sense for this particular type of client. So in this scenario, we're starting out with an account balance of $52 million. We're going to assume the same gross return in both the non-insurance based investment as well as the life insurance policy. We're assuming an average capital gains tax rate in the non-insurance based investment account of 37.05%, and we're also accounting for the 40% in estate taxes. In the blue column here, this is the non-insurance based investment account. And the values in this column are the after-tax values. In other words, these are the net values that would go on to Generation 2 at end of life. In the green section here, this is the exact same non-insurance-based investment account. The difference, however, is we are drawing down this column right here, and these are the interest-only payments for the premium finance life insurance policy. And again, we're drawing those down from the non-insurance-based investment account. In the far right-hand column in the green section here, these values represent the total portfolio value, including the life insurance death benefit. In other words, we're including both the after-tax value of the non-insurance-based investment account, as well as the policy death benefit. And on the right-hand side of the screen here, you see the green line represents the non-insurance-based investment account balance. Obviously, we have drawn down amounts from that account to pay for the interest only on the premium finance life insurance policy. And this green line also represents the death benefit. So it's the combination of the death benefit of the policy as well as the non-insurance based investment account balance. The blue line, however, represents the exact same non-insurance based investment account without taking any drawdowns to fund a life insurance policy. So this is just the non-insurance based investment account without the life insurance. Clearly, adding premium finance life insurance to this client's overall portfolio far outperforms them just leaving the money in the non-insurance based investment account. When we calculate the total cost of liquidity in the green columns here, this is the premium finance life insurance policy. And we're going to assume life expectancy is right around age 86. At age 86, the projected death benefit amount net of loans is $24.7 million. In the second column here, this is an equities and bonds account, and we're contributing the same amount to this account as we are spending in interest payments in the premium finance life insurance policy. As we see here, the after-tax value at age 86 is only $11.3 million compared to the $24.7 million in premium finance life insurance death benefit. Again, that's net of loans. So that's more than double the outcome. And again, this is assuming the same 6.3% gross return in both the premium finance life insurance policy as well as the equities and bonds account. But some clients say, well, I can get a greater return than 6.3% in my equities and bonds account. Though that may be true, if that was the case, the index return in the premium finance life insurance policy would probably be greater than 6.3% as well. So in this scenario here, we're just comparing apples to apples. If the client wants to know what they can do to generate the same $24.7 million in outcome at life expectancy, again, this is after tax. If we look up top here, the client would have to earn a gross return of 15.37%, which is more than double the gross return that we are showing in the premium finance life insurance policy. And then lastly, in the far right-hand column here, assuming the same 6.3% gross return and assuming the same $24.7 million in net after-tax value at age 86, the client would have to contribute $1.7 million over a 15-year period. That's $26 million in after-tax contributions compared to only $13 million in the premium finance life insurance policy. So this is what we call calculating the true cost of liquidity. In other words, what is the least out-of-pocket expense the client can have to generate the maximum amount going to Generation 2 at end of life, net of all taxes. Well, we hope you enjoyed today's webinar. For more information about us, you can visit us at lionsmarkcapital.com, or you can also visit my YouTube channel.